Good morning, everybody, and welcome to this edition of our weekly Think Tank for Monday, 28th of June. My name is Carl Capelinga, and I'm the market analyst over here at Think Markets Australia. It is a pleasure to be with you as we wrap up all the key events from last week and look to the week ahead. We'll do that after we talk about the Think Markets difference, of course, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, no hidden platform or subscription fees, and of course, a world-class trading app. 5 fantastic reasons to make sure your next ASX share trade is with Think Markets. And if you are very quick now, June 30 is the cutoff for this one. Sign up, get trading, and your first 5 trades are on us. There are some T's and C's, so head to the website for further details. The agenda for today is to, as I said, wrap everything from last week. We'll kick off with that crypto market update, some exciting developments there. Then we'll look at all of the major economic data that was released last week, see where the value lies in the Australian market, if there is any value at all. Check out some of the key technical analysis indicators, and then check out the calendar for the week ahead. Okay, big crypto update to start off with. Okay, big crypto update to start off with, and we're going to kick off taking a bit of a longer term view now. So we're looking at a weekly chart of the total market capitalization of the cryptocurrency universe, excluding Bitcoin. And there's a big reason why I want to exclude Bitcoin. Obviously, it's the biggest of the lot. It takes up, depending on where you are in this chart, of course, somewhere between sort of 2/3 to a half of the crypto universe. So a move in Bitcoin is therefore going to skew what we want to investigate here, which is what the broader space is doing. And this is the 2017-2018 rally, bull market, if you want to call it. This is what many people in the space refer to as the Bitcoin winter. There was a blip up here in 2019, and it was more pronounced on Bitcoin, but less so in the alts. And I guess that's another way to describe the chart of what we're seeing here, which is the alternative coins. So we call them alternative to Bitcoin, if anything else. And the key takeaways here, obviously, is this massive run up, immensely eclipsing what we saw previously in terms of raw price movement. And this very sharp pullback here after what was a very indecisive candle here, with the very small black body and the large shadows either way. So indecision within an uptrend can often lead to an increase in supply if the bears take control. But you wouldn't necessarily say that that candle was a guarantee of this big black one here, this one here. We saw indecision here, for example, and here also, where the trend did continue. But look, nonetheless, history shows us that we saw this very sharp pullback. It was a response, or an indirect response, we should say, to the Elon Musk comments, the beginnings, the rumblings of a China crackdown as well. That the China crackdown, you would say, is the cause of the second dip down. It brings us into the short-term uptrend zone. Now, we would expect that this is an area where we would see dynamic short-term support. So dynamic because the moving averages, which create this zone, continue to move, and support in that we would expect it to bounce off this zone. And it did that a few weeks ago. The problem is we're plunging back into the zone as we speak. The rally out of it this time is far smaller. You can see, as evidenced by the height of that shadow there. And the problem is, and let me get to the point here, the problem is if we break through this zone, there's really not a lot holding us up until we get back to the long-term dynamic trend zone, which is so much further down. And that would spell another, let's call it, nuclear winter for crypto assets in general. We haven't closed beneath that zone yet, so that is modestly positive, but you would not look at that typically and go, that is a chart that I would like to buy based upon what the technical indicators are telling us at this stage. Let's have a look at the market dominance of Bitcoin. So I mentioned before that anywhere between, give or take, 2/3 to about a half is typically where Bitcoin has been in terms of its proportion of the broader crypto universe. The reason why we start up here at 100% is because Bitcoin was the original cryptocurrency. So of course it had a 100% market dominance at one stage. But what we do tend to notice is that the dominance of Bitcoin tends to fall as we move into the top of the market. Okay, so as Bitcoin initially grabs the attention of the market, obviously starts to go up, and then the attention flows through to the alternative coins. So this bottom in Bitcoin here coincides with this top right here. Now, obviously, they're different scales, so they won't coincide when I flick the slides, but that is exactly what happened. As we have the pullback, the correction in the broader crypto market, so here and here, we tend to find that the dominance of Bitcoin rises again as there is potentially a flight to quality, or more potentially that Bitcoin tends to fall less on a relative basis than everything else. And we're seeing that playing out now. So we're seeing almost exactly the same market dynamics as we saw in that 2017 correction, as we've seen the high in the broader crypto space. Obviously, Bitcoin peaked first, then the broader crypto space, and now the market dominance of Bitcoin is increasing again. So history doesn't repeat, but it appears to be rhyming. Having a look at the Bitcoin price, now I obviously prepared this one this morning, but literally as just after I prepared it, we have seen a move up in Bitcoin. No real news out there. There's a story maybe of a Mexican bank looking to get into it. Earlier in the week, there was a story about Jack Dorsey, the Twitter founder, challenging Elon Musk to have, quote unquote, the chat or the talk about Bitcoin at an up-and-coming Bitcoin conference. Elon Musk has accepted, so no doubt that's a broad positive for Bitcoin in terms of the rhetoric that may then be spurred by this conversation. That was in the market on Saturday. It's Monday morning. I'm not sure if that caused it, but either way, we're challenging that $35,000 level again, but it comes within a broader short-term downtrend and a long-term uptrend, which has switched from that previous equilibrium market into a supply side market. I do believe now that the long-term trend, unfortunately for Bitcoin, is down, and we can see the short-term downtrend is down. We're getting that consolidation in and around this zone, and with downward bias towards it. Balancing that out somewhat is the fact that we continue to probe into this 28,000/30,000 level, and we keep bouncing off it. Plenty of support, obviously, also back here earlier on in the year. So we're a little bit stuck in the middle, but compressing with a slight downward bias towards the bottom of that range. Look, I hope I'm wrong here, because I do want to see the cryptocurrency space thrive and prosper. But unfortunately, first and foremost, I'm a technical analyst and a trend-following technical analyst at that. And I do believe that the greater risk is that we do break below this support level and tip out to around about 20,000, which is going to be this big support level from December last year, but it's also that 2017 peak. So there's also a little bit of, I guess, sort of a completion of that big move that we had in this run. Bottoming out at the top of the last run. So that would be an area I'd be very interested in. And if we saw a big sell-off on some big volumes, some big volatility here and here, then I'd be very, very interested to put some of my own personal wealth at work in Bitcoin. I do have some cryptocurrency holdings, not in Bitcoin. I haven't owned Bitcoin for a while now, obviously since you can see why on the chart, but I'd be looking to get back into it if I saw the right conditions down here. Look, as I said, I hope I'm wrong, and I hope instead we see a break back up above this developing resistance zone. I think you really want to be quite patient with this, and I think 42,000 is going to be a key level, and if you start to see certainly a close in that zone, that's when I think we are starting to move back into the demand side market out of this, what we will go on to say was an equilibrium phase here. So plenty going on Bitcoin, clearly, and you will need to stay on your toes. Having a look at Ethereum, now this is the key altcoin. I'm sure the true believers in Ethereum would have cringed when I called it an altcoin. But let's just stick to the technicals here and acknowledge that we are very much in this short-term downtrend phase. It is clear the long-term trend is very much under threat here, and if anything, potentially is broken to put us firmly into a supply-side market. We're in trouble here on Ethereum. Once again, look, hopefully we can find some support. It's hard to see it shooting back up very quickly. More likely, if it was to recover, we would have to see a period of at least consolidation and demand building through here around that long-term zone. So, yeah, if you're looking to put some money at work in the crypto space at the moment, I'm not seeing, at least in the two majors, a confident, a strong confident place to do it at this point in time. The third major we're going to look at today is Cardano, simply because it is, off the top of my head, the only one that is still in a long-term uptrend, which is commendable. But short-term downtrend is persisting, and it is pressuring this long-term trend zone here. A reasonable bounce of what is clearly support around that $1 mark. That's very interesting. A little bit of help there in the volume and the volatility to potentially suggest that's a low, but again, we're going to need to see some demand building through here, some higher peaks and troughs coming back in before we get too excited, and we'll just have to keep an eye on where that might occur. And of course, stay tuned to these updates. Having a look, or bringing it back to the share market now, the ASX 200 down 0.83% for the week, and that was on the back of a large fall in financial stocks, down about 2.6%. Commonwealth Bank down over 4%, Westpac, ANZ and the rest down somewhere around about 3%, Bendigo down about 5%. So it was a broad-based move to the downside. Healthcare looks worse with a 4.3% fall, but I do note about 6.7% of that was CSL. CSL is the biggest weighting in that index, and outside of CSL, look, the index really wasn't that bad at all. So financials, the big pullback there. Energy continues to suffer here despite a strong rise in the crude oil price during the week. Otherwise, to the upside, information technology continues to prosper on the back of that move higher in the NASDAQ. In the USA, materials, we saw a nice bounce up in some of the commodities. We'll talk about that in a little while, so good performance there. And it is my sector pick this week. Property trust did well, staples, telecommunication, not bad. Utilities continues to be down in the doldrums as we saw bond yields, long-term bond yields spike back up, certainly in the US, and heading into the chart of the ASX 200 to get some key levels for the week. In terms of support to the downside, I would be watching the 7173. I think we're very, very well supported there, and also probably into a little bit of a band more than just a single point with that last week's low of 7216. We are going to be supported, I think, here with a short-term dynamic trend zone. You can see in the past, it's consistently the point that we do tend to bounce off, so that's encouraging, and the long-term trend is well established and up. Looking at resistance levels, 7407, clearly the all-time high now, is something we would probably spend a day or two to get through, but otherwise I do think the trend is very strong, very intact, and you do need to continue to look to apply capital to the long side. Having a look around the region, Asian stocks were stronger last week, in particular Shanghai, which actually looks very good. Go check out that chart. In the US, fantastic performance across the board there. S&P 500, a couple of record highs and a nearly 3% gain. The NASDAQ a little bit less, but also looking very good on the chart. The volatility index plunged to a post-COVID low, down 25%. That's great for stocks going forward. We're nudging towards that sort of 15, or getting into that zone beneath 15, which is where the best bits of the bull market have occurred over the last couple of decades. European stocks higher, albeit not as good as some of the rest. Having a look at the S&P 500 chart, and it is the absolute stairway to heaven. We keep bouncing off that short-term dynamic zone. That's why I keep rabbiting on about it. We are within this beautiful long-term uptrend, and there's really nothing sinister in the candles there to suggest that we can't continue to trudge on. It won't be an up every day proposition, but I do think the trend will continue to the upside. When could it stop? What could challenge the trend? Well, a candle that looks like that would certainly challenge the trend. One of those big black supply events, nasty looking things. When they occur, and they do tend to predict, the first shot of supply, which then tends to persist for a period of time. But there's nothing even remotely resembling that volatility in the market at the moment. Also heading higher than NASDAQ, and it does look really good because it is just moving out of this beautiful big ascending triangle. If you want to measure sort of targets, that's you're looking at something around here, and whatever that might be, 15,500 to 16,000. Again, it'll be a slow and steady process to get there, but the overall trend is magic at the moment. Having a look at some of the industrial metals markets, copper, a nice gain there. It's always good when copper goes up because it tells you that global economic growth is expected to be strong, and that's good for stocks as well. Lead, nickel, great move. Nickel, 8%. We'll have a look at that nickel chart in a second. Tin also doing well. Zinc, a reasonable move there. Copper in the US up 2.88%. I'm not sure about that one. Data provider gets a bit sketchy at times, but let's go with a small gain certainly in the Singapore dollar price. I do have a chart coming up so we can confirm, and then gold having a small bounce back, but certainly nowhere near as much as the industrial metals. Having a look at the chart of copper, we can see at 9042 that low is above this support point here at 8768. It's also above the long-term dynamic trend zone, so that is supportive of prices continuing to bounce off this level and potentially to go up and challenge some of these resistance points here. But otherwise, happy to back copper stocks on the ASX. Nickel looks really good, actually. I think anytime you see this sort of a sharp move down, and this was on that Tsingshan move, the big nickel producer out of China, who said they had a new process for producing nickel matte from nickel pig iron. Now that's like cracking the Da Vinci Code, and all of a sudden there's a whole heap, potentially more supply of nickel matte, and that's the stuff they use in electric vehicle batteries. So it shocked the market. Changed the supply-demand dynamics. But when you see a price fall like that, steady, and then pop back up, that is an absolutely strong sign that whoever was buying down here, they knew exactly what they were doing. They're buying into that fall. They soaked up all of that supply, and with that supply gone in the market, really, we're ready now in that supply vacuum to move higher. Long-term trend still intact and moving out potentially of a bit of a triangle pattern. So copper looks good, nickel looks good, iron ore looks great, and confirming that that fall in Shanghai I don't think was accurate. But looking at the Singapore dollar price here, we are hovering above that $200 a tonne and not looking like having a move, as the naysayers would insist is going to occur back to sort of $100 a tonne. I just can't see that happening. Now, I'm not unrealistic as well about the iron ore supply-demand dynamics. I think the market is well supplied, but demand is also quite robust. I think, if anything, prices will probably hover around here. If we do see pullbacks, look, I think somewhere around 180 is probably as bad as it might get in the medium term, and it still means significant upgrades because a lot of the brokers still have estimates somewhere in this zone. So if you're an iron ore stock at the moment, you're being valued here. If we stay here for 6-12 months, and the longer we stay here, the better, you need to be upgraded. Your earnings need to be upgraded, your price targets need to be upgraded, and brokers need to tell their clients to buy because you're looking too cheap. And you look at some of our big iron ore miners, BHP, Rio, Fortescue, the dividend yields are fantastic as well. Fortescue is sort of an 8.5-9% fully franked dividend yield. Have a look at gold, not as exciting as some of the other industrial metals. I do think, and I've said this to you a number of times, I do think we are in a bear market for gold that started here. I don't think it's necessarily going to be a ferocious bear market, but I just don't think we're going to be making new highs anytime soon. In the short term, supported, I guess, around this sort of 1755 level, but probably going to be resisted here around 1800 as well. So maybe bottom line there is stuck in the middle with some slight downside. As I mentioned earlier, a strong move up in crude oil prices does really throw a question mark over how weak our Australian energy sector is. It's looking very, very cheap on 1-year forward PEs at least. So again, if we can find the right charts, there are stocks there at the right price. Having a look at currencies, the Australian dollar bounced back quite strongly, up 1.5%, but that's just reversing most of the falls it had the week before as the US dollar more broadly declined. We saw some higher bond yields, but particularly in the USA, as we saw markets continuing to adjust to this idea that the Fed is probably closer to at least tapering than it was, before they released their minutes a week and a half ago. Having a look at some of the data out during the week, and we'll just whiz through these because I can see we're growing short on time. Australian retail sales, look, really neither of these, that's the PMIs we saw, so the manufacturing and services Purchasing Managers Index that were released during the week. Neither of them are going to give us any serious data about the Australian economy because they were negatively impacted by the Victoria lockdowns. And look where we are right now. We've got lockdowns in most parts of the country. Well, lockdowns or restrictions, and therefore we're not going to get any solid reads on the Australian economy until some of this washes through the system. If it ever does, maybe this is just the way it's going to be. And therefore, some of these terrible reads, maybe that's the reality. And therefore, again, maybe the Reserve Bank isn't going to be doing anything anytime soon because of the uncertainty that the COVID situation creates. And I think maybe that's the message to take away from today's economic data. We saw durable goods orders bounce back 2.3% in the US, certainly better than their 1.3% decline in May, but worse than expected. Interesting, worse than expected on that one. In terms of the services and manufacturing PMIs, we saw the services one significantly lower and worse than expected. We saw the manufacturing one about the same, look a little bit better, but we are seeing the similar themes in both. So backlogs, increasing input costs, scarcity of labour. That's very interesting, and it's hard to get the right people to do the right job, and they are starting to ask a little bit more money. So that's inflationary in itself, interesting. A big employer in the US, significant employer in the US economy is the US housing market. So that's continuing to trend lower. That's interesting. So durable goods not so great. US home sales not so great. And we're seeing a little bit of a tick up here in weekly unemployment claims, although continuing claims continuing to ebb lower. But with just under 15 million Americans still claiming some form of unemployment benefits, once again, you have to believe that these easy monetary conditions are going to persist longer than some are potentially saying after those FOMC minutes. I don't think they're going to do anything crazy, and if they do, they're going to flag it way in advance and do it very, very slowly. Looking at expenditures, we did see them fall and fall more than expected. So people spending less money. We are seeing incomes fall, and that's because the US federal government is withdrawing some of that stimulus. So again, not exactly showing a rampaging US economy there. And some good news on inflation, actually. The Fed's preferred measure of inflation, the PCE pricing index, we saw that come in at 0.5%, which is a big print, let's face it. That's a rapid increase in inflation there on a monthly basis. And we got some really crazy year-on-year reads here. Let me check my notes. So 3.9% in the headline to the year ending May, but there are some base effects there. If you look at what was happening 12 months ago, May 2020, it was the end of the world. So inflation was very low, in fact falling. So that probably explains it as well. So I'm not too panicked by that. The core was at 3.6%. Look, it's above the Fed's 2% level, but they've told us, they keep telling us, hey, we expect this to happen. We're not going to do anything crazy. And even if inflation did stay above there for a period of time, they've told us that their stated goal is getting America back to full employment. So it's more important than what's going on in the short term on these things here. Let's have a look at how, I guess, the market responded to this economic data. So we've heard the economic data. How did the market respond? And if this trend is down, we are seeing the market believing that the data is pointing towards a weaker economy, and that's why rates are coming down. That's what's happened in Australia. Let's have a look at the US. Look, probably flat for the week, but I do note this little uptrend here. We bounced off this long-term support zone. It's really a resistance zone because these are yields. So this is the opposite to bond prices, right? Bond prices. So where this is, it looks like support here. This is actually resistance because you kind of have to flip this on its head to get the bond price. Once again, look, if we're heading up, that's looking like a stronger economy, or at least higher rates down the track, higher inflation, higher rates, and rates. So look, it's not a clear-cut move to the upside yet, but it does appear to be building something here which we do need to watch. What does it mean for share prices? Hey, look, as long as we're in here, we're in the Goldilocks zone, it's all good. If we get up here, that's bad because we've got too much of this inflation. If we get down here, that's also bad because we don't have enough of this economic growth. Okay, so whilst we're in the middle, we're all good. Something I haven't seen for a very, very long time, certainly not since I've been reporting to you for Think Markets, is the Australian one-year forward PE falling below 18. And a big drop during the week by about 50 basis points there. And not only are we looking much cheaper, but we're looking much cheaper than the rest of the world as well. So you can see this blowout here. Now, what could cause this? Because we know, share prices on the whole have been going up over the last few weeks in Australia. So prices have been rising. And if we look at what our PE is, it's price divided by earnings per share. So prices have been going up, but overall the PE is going down. And that can only occur if earnings, and that is expected earnings, are going up faster than the prices. And that is good news. Higher earnings is supportive of a stronger share market down the track. So I look at that as a big positive. Where is the value in the Australian market? I still think it's in the materials sector. Like a broken record here every week, I tell you, hey, there's great value in the materials sector, and it's looking even cheaper than where it was a month ago because we've had a pullback in prices. So we've got great value and discounted prices. Definitely my sector pick for this week. Sector stock picks, I'll put those up on the website a little bit later on this week, but definitely look at Mincor, ticker code MCR. I like ASX Resources. I published that on Friday in the market news section. Go check that out. Mineral Resources, ticker code MIN, and the one that is escaping me right now has just popped into my head, Linus Rare Earths, ticker code LYC. But there are many. We did a mining stocks webinar a week and a half ago, I think it was, maybe a couple of weeks ago. It's on the website. Go check that out. They're my key mining picks. And the rest of them, press pause. Much of a muchness. Let's have a look at the market breadth. So we're looking at how the stocks within the ASX 300 are performing versus their technical trends. Long story short here, we want to see, and this is, where are we now? We're at the orange line. And we want to see that as high as possible. Yep. And as flat as possible across all those time zones. That is as strong as you can get when that occurs. And obviously we want to see us as close to the record high, which is here, and we are. So look, Australian market is very, very strong at this point in time. Lots of participation in the trend. And maybe not as evidence in here. We have had a little bit of a pullback in the energy sector because that was up neutral just last week. Financials were back to just neutral up. We talked about the declines there. We did see a flattening of the yield curve. That hurt them, but US bonds ticking back up towards the end. Maybe we're going to see them bounce back this week. Gold is something I would not touch still. Healthcare took a beating last week, but mainly on CSL, so I'm still okay with this. Look, the double greens, by default, I'm okay. Materials, we went neutral a couple of weeks ago, but what that's allowed us to do is to have that, that pullback within that long-term trend, okay, and getting some setups here. Whereas financials, we're kind of doing that. We haven't yet had that pickup. So, once again, this is the place I'm looking for this week. But otherwise, ticks on anything that's double green. Utilities, maybe just pause there. I think it's still too early on that trend or that developing trend. Pretty quiet for the week ahead in Australia. I'm going to say nothing there. Nothing there is going to move the market, I can assure you. Having a look around the world, this will be important here. We've got some Chinese manufacturing and services data. That's the official National Bureau of Statistics data. Then we have a flash reading on European consumer inflation. That will be interesting. ADP employment change, which is really a precursor to the official government data, non-farm payrolls on Friday. That is the biggest of our regular monthly releases. And then we do have some manufacturing data and some manufacturing prices. Very interesting there on Friday. And apart from that, it's all pretty quiet, I would say. We've got the KCN PMI, which will just back up the official stuff, and then maybe Chicago PMI as well, which is probably not as important as this one here. Okay, well, that's it for me today. I'm sorry I dragged you over time, but sometimes I get on a roll. Okay, let's have a look at where you can get the rest of that information. Head to the market news section. Lots of research, news, views, opinions. You can follow me on Twitter. I'm often tweeting charts there. You can head to the webinar section and register for tomorrow's crash course in crypto, where I'll bring you up to speed on what this crypto stuff is all about, and hopefully give you some practical tools you can use to get the information you'll need to do your analysis. And obviously register for the rest of these as well. Okay, the disclaimer before I leave you says that everything we've discussed today is general advice only. You do need to do your own research and make your own decisions with any of the information I've provided today. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit, so it's important you read this disclaimer carefully, or if you have any questions at all, please give us a call. Well, that's it for me. All the best for your trading. Until we catch up again. Bye-bye for now.